Hey guys, welcome back to my channel. In the last session, we looked at income, savings, and investment. In this session, we are going to look at protection as the final factor of personal finance. What is protection? In simple terms, protection refers to a wide range of products that can be used to guard against unforeseen and adverse event. What are the four types of protection that we have? Protection can also be referred to as insurance. What is life insurance? A life insurance policy is a contract with an insurance company. In exchange for premium payments, the insurance company provides a lump sum payment, known as death benefit, to the beneficiary upon the insured death. Typically, life insurance is chosen based on the needs and goals of the owner. Therefore, life insurance is basically a contract between the insurance company and the insured. And the insurer, which is the insurance company, promises to pay a particular amount to the beneficiary, while the insured, that is the policy holder, pays a certain amount of premium within a specific period of time, either monthly, quarterly, or yearly, or they pay it in lump sum. Life insurance, which is also known as a life cover or life assurance, is also a type of a policy that protects your loved ones, that is your family, when you die. In other circumstances, it can replace the income that you used to receive when you die. Alternatively, it can pay your loans or any outstanding debts, therefore protecting your dependents from suffering the consequences of debts or loans that you could have taken. The second one is health insurance, and health insurance is a type of an insurance coverage that typically pays for medical, surgical, prescription drugs, and sometimes dental expenses. We have health insurance that covers part or whole of the risk of the person incurring the medical expense, therefore spreading the risk over numerous persons. An example of part health insurance is when we have maternity, whereby the insured is undergoing C-section, and this is not the first C-section they are having. Therefore, the insurance opts to pay a certain percentage out of the whole bill. Therefore, the insured has to contribute either 30% or 20% of the amount that is incurred, because the policies or terms of the insurance company is not to fully cover the medical expense. The third one is long-term disability insurance, and this is an insurance policy that provides income replacement for workers if they become unable to work due to an illness or injury, so they can continue paying bills and meeting financial goals and obligations. It is an essential part of being fully insured, but many workers usually don't have it. There are two types of long-term disability insurance policy. One is own occupation and any occupation. The difference is how they define disability. own occupation disability defines a disability as an inability to work at your regular occupation. Any occupation disability insurance defines a disability as an inability to work at any occupation. These plans are harder to claim benefits from, but they are usually cheaper. And this is because it is difficult to prove that you cannot do any job at all, which is really hard to sell or just to prove to the insurance company that you are completely incapacitated. We also can classify them as short-term or long-term disability insurance. And short-term, it's temporal injury which is able to recover. That is, a patient is able to recover. However, the long-term, a person is injured permanently, like if you get physically disabled, therefore you perhaps have to use a wheelchair for life, or you may totally go blind if you were once seeing. Yeah, that is the difference between the short term and the long term. An auto insurance is a policy purchased by a vehicle owner to mitigate costs associated with getting into an auto accident. Therefore, a vehicle insurance is an insurance for trucks, cars, motorcycles, and other road vehicles. Its primary use is to provide financial protection against physical damage or bodily injury resulting from traffic collision and against liability that could arise from incidences in a vehicle. Therefore, we see that protection is all about minimizing risk from low, medium, and high risk. So you ask yourself, why is it important to have protection? As your main source of income, protecting your business is important to ensure your continued financial security. Having a plan in place can help ensure your business continues to run smoothly should the unexpected happen. Protect your business against the permanent losses of a key person during death or disability. We see that protection is very important. Protection, therefore, is asset protection, and it is a concept and strategy for guarding one's wealth. Asset protection is a component of financial planning intended to protect one's asset from creditor's claim, from a loss that can incur due to an unforeseen event, or guarding your health or guarding your loved ones. And protection is a very important aspect of personal finance. Now, in our next session, we are going to look at budgeting. That will fall under income. How do you budget your income? What is the importance of budgeting? And among others. Thank you for watching and staying tuned. I look forward to the next session. See you, and thank you so much. and bye-bye.